Welcome to Talk Tickers.
Good to be here.
We are back in the weeds today. And by weeds, I don't mean we're looking at some messy balance sheet for a mid-cap retail stock or, trying to decipher a CEO's mumbled guidance.
No, this is deeper. We're looking at the plumbing of the private markets.
The stuff that usually stays behind the curtain.
Right.
The machinery that makes the whole asset class function.
Right. And right now, that machinery is, it's grinding to a halt.
Exactly. And that curtain is twitching a little bit. The whole mechanism that keeps the private equity world spinning, specifically the exit mechanism, is jammed.
Jammed is a polite way of putting it. I mean, it's practically welded shut in some corners of the market.
Let's just look at the board for a second. M&A activity.
Yeah.
Muted. The strategic buyers are just sitting on their hands.
Totally.
The IPO window. Erratic. I mean, it's bordering on non-existent for long stretches. And here's the number that should scare anyone with, a pension fund or an endowment portfolio. Distributions to paid-in capital DPI.
Ah, the magic number.
It's trailing historical norms by roughly 15%.
Which, just in plain English, means the cash isn't coming back. You put $1 in, and usually by year 5 or 6, you expect to see some quarters rolling back your way. Right now, the mailbox is empty.
The cash is trapped. And when cash is trapped in an asset class that relies on velocity, on recycling capital, people get creative.
They have to.
So today, we're dissecting the specific tool, the mechanism that general partners or GPs are using to force that window open. It's called the continuation fund.
Or CV, if you want to sound like an insider at a dinner party.
Right, the CV. Now, before you tune out thinking this is some dry back office accounting maneuver, just look at the money on the table. In 2025, GP-led transaction volume hit $115 billion.
And continuation funds represented 89% of that activity. So this is not a niche anymore. This is the market. You're in private equity, you're either doing a CV, thinking about a CV, or analyzing a CV right now.
That is the market. I mean, we are talking about a fundamental shift in the physics of private equity. We're moving from that classic 10-year buy it, fix it, sell it cycle to something that looks a lot more like an indefinite hold model for what they call trophy assets.
It's the Hotel California of asset classes. You can check out anytime you like, but the asset can never leave.
So here's the mission for this deep dive. We are going to tear apart the continuation fund. We need to understand the mechanics, how the money actually moves.
And the conflicts of interest, because let's be honest, they are massive.
Massive. We need to talk about taxes, which is where the bodies are buried. And finally, we need to answer the question, is this a desperate patch for a liquidity crisis, or is this the new permanent structure of private equity?
It's a crucial question. Let's get into it.
Okay, start at the very bottom. For the listener who hears continuation fund and just hears noise, strip it down. What is physically happening in one of these deals?
At its simplest level, a continuation fund is. It's just a new bucket. A private equity sponsor, the GP, they set up a new special purpose vehicle. Let's call it Fund B.
Okay.
They use Fund B to buy one or more companies out of their old fund, Fund A.
So the GP is the seller representing Fund A, and the GP is also the buyer managing Fund B.
Correct. It is a sale from the left hand to the right hand. The asset technically doesn't leave the manager's control. The CEO of the company doesn't get a new boss. The strategy doesn't usually change.
There's a big but.
There's a big but. It is a real transaction. This is the crucial part. It's not just a journal entry.
Why does it have to be a real transaction if it's just moving from one pocket to another? Why go through all that hassle?
Because the investors in the left pocket, the limited partners or LPs in the old fund, they need to get paid. They've been in that fund for 10, maybe 12 years.
The clock has run out.
The clock has run out. They have liability matching to do. They need their liquidity to pay pensioners or fund university scholarships. They need cash.
Okay, so the old fund is at the end of its life, but the GP looks at the asset, let's say it's a high-growth software company, and says, wait a minute, this thing is a rocket ship. If I sell it to a competitor now or try to IPO in this terrible market, I'm leaving money on the table.
Exactly. They are caught between a rock and a hard place. The rock is the mandate to return cash to LPs. The hard place is their fiduciary duty to maximize value. If you sell a winner too early, you're failing. If you hold it forever and don't pay your investors, you're also failing.
So the continuation fund is designed to solve this dual mandate.
It creates a fork in the road. Mandate 1, liquidity. The existing LPs in the old fund get a choice. They can cash out. They take their share of the sale price and they walk away.
And mandate 2.
Mandate 2, duration. The GP gets to keep the asset in the new fund, the continuation fund, and ride that growth curve for another 5 or 7 years.
It's having your cake and eating it too. You pay out the people who want to leave, and you double down with the people who want to stay.
That is the theory. And within this world, we see two main flavors. And you really have to distinguish between them because the risk profile is totally different.
Okay.
First, you have the single asset continuation vehicle, the SACV.
That's the crown jewel strategy.
Exactly. This is when the GP has one company that is absolutely crushing it. It is the outlier in the portfolio. They build a whole new fund just around that one asset. These are the ones hitting the headlines because they are concentrated bets.
And the data suggests these perform better, right?
Generally, yes.
Yeah.
Because it represents the GP's highest conviction. They aren't going to go through the brain damage of setting up a CV for a mediocre company. It takes months of work. You only do it for the absolute winners.
Okay, so that's the SACV. What's the other one?
Then you have the multi-asset continuation vehicle, the MACV. This is where they sell a strip of assets, maybe 3 or 4 companies.
Yeah. Is that more of a cleanup exercise?
It can be. It's often used to wind down an older fund completely. Let's take the last 4 remaining assets, bundle them up, and move them out. It offers some diversification for the new investors, but you have to be careful. You aren't just buying a bundle of leftovers. Sometimes it's a mixed 1-star player and 2 bench warmers.
Right. Now, you mentioned the scale earlier, 115 billion, 75% of large firms are doing this. But it wasn't always this way. If we rewind the clock to, say, the post-GFC era, 2009, 2010, this tool existed, but it had a smell to it.
Oh, it had a terrible stigma. If you saw a GP doing a continuation fund in 2010, you assumed they were in trouble.
Why? What was so different?
Back then, they were purely defensive measures. They were used for zombie funds.
Zombie funds. I love that term. It sounds like a B movie.
It felt like one for the investors. These were funds where the 10-year clock ran out, but the assets inside were basically dead on arrival.
Yeah.
Distressed companies, bad real estate deals from 2007. They couldn't sell them because nobody wanted to buy them.
So the CV was a life support machine.
Exactly. The GP would create a restructuring vehicle just to buy more time, to salvage pennies on the dollar. It was an admission of failure. It meant I couldn't exit this properly within the time frame I promised you.
So how did we get from saving the zombies to keeping the crown jewels? I mean, that is a massive psychological shift for the industry.
The pivot really happened between, say, 2018 and 2024. The mindset shifted from saving troubled assets to keeping the winners. GPs started looking at their best companies, businesses they knew inside and out, and realized that the traditional model was, frankly, irrational.
Irrational how?
Well, think about it. You've been 5 years building a great company. You fix management, you fix the product, you integrate acquisitions. It's finally compounding at 20% a year. Why would you sell that to another private equity firm just because a clock on the wall struck 10 years?
You're just handing the upside to your competitor. You did all the hard work, and now they get the easy growth.
Precisely. Why surrender the future compounding value? So the logic completely flipped. Why sell your winners? Became the mantra. But then, and this is key, we hit the liquidity crisis of 2022 to 2025.
The denominator effect.
That put the whole trend on steroids. Public markets wobbled. Private markets didn't mark down their assets as fast. Suddenly, institutional investors found themselves way over-allocated to private equity. Their portfolios were lopsided.
So the pension funds and endowments basically just said, hold on, we can't give you any more money until you give us some money back.
They were screaming for DPI, show me the cash. But the traditional exits were closed. No IPOs, no strategic buyers. So the continuation fund went from being a strategic nice-to-have to a necessary all-weather tool. It became the only way to manufacture liquidity when the world stopped buying.
Okay, so we've established the why. It's a mix of greed keeping the winners and fear needing to pay back investors during a drought. Now I want to get into the gears of how it actually works. Because if I'm an investor and I get a letter in the mail saying, we are moving asset X to a continuation fund, I need to know what's happening behind the scenes.
It's a complex dance. There are 4 main participants. We already met the seller, the old fund, and the buyer, the new fund. But because the GP controls both, you have a massive conflict of interest.
Which is where the alarm bells should start ringing. It sounds like me selling my own used car to my wife using our joint bank account.
That's a pretty decent analogy, except imagine you also get a fee for facilitating the sale. So to solve that conflict, you introduce the third participant, the lead investor.
And who is this?
This is usually a dedicated secondary fund. Firms like Lexington, Collar Capital, or sometimes a syndicate of sophisticated buyers, their role is absolutely critical. They set the price.
This is important. The GP doesn't just make up a number and say, this is what it's worth.
Oh, they can't. That would be a lawsuit waiting to happen. They need price discovery. They have to conduct an auction. The GP hires an advisor like an investment bank, maybe Evercore or Lazard, to shop the asset around to these secondary funds.
So it's a test. If you think this asset is worth $1 billion, go find someone willing to write a check for that amount.
Exactly. The lead investor comes in, does deep due diligence, they get a data room, they meet management, they analyze the market, and they say, okay, we are willing to anchor this new continuation fund. We will buy the asset at this valuation. They negotiate the terms, the fees, and they usually take a majority economic interest in the new vehicle.
Okay, so the price is set by the market, theoretically. The lead investor validates the valuation. Then the LPs in the old fund get the letter. This is the fork in the road you mentioned. What are their options?
Typically, they have a 30-day election period. That's the ILPA recommendation to decide. It's a tight window.
Very tight.
Option 1 is cash out.
The clean break.
You sell your interest at the price the lead investor set, and you take your liquidity, you're out. Done. The money hits your account.
Option 2?
Option 2 is roll or reinvest.
Yeah.
You say, I like this asset. I trust the GP. I want to keep riding the wave. You take your stake, your value in the old fund, and you contribute it into the new continuation fund.
You're doubling down.
You are maintaining your exposure. But then there is option 3, and this is the controversial one, the status quo option.
Status quo sounds comforting, like don't touch my stuff.
And that is the nuance, right? Status quo is not a legal term. It is a marketing term. It implies you retain exposure on substantially similar economic terms to the old fund.
But substantially similar could cover a lot of sins.
It does. Does it mean no new fees or just the same rate of fees? Remember, the old fund probably had no management fees left because the investment period was over. The new fund definitely has fees. So if you choose status quo, are you suddenly paying 1% again? And usually you're rolling into a vehicle that has a new 5-year lockup. It is a critical but ill-defined option that investors need to scrutinize with a microscope. Status quo rarely means exactly the same.
Let's talk about the price tag itself. You mentioned the lead investor sets the price. Are these assets trading at par? If the GP told me last quarter the asset was worth 100, is the secondary buyer paying 100?
Rarely. It depends heavily on the asset quality. Single asset deals, the crown jewels, can command better pricing, maybe even a premium if it's a hot asset in a hot sector like AI or data centers.
But generally,
transactions often trade at a discount to the prior reported net asset value, or NAV.
So if I choose to cash out, I am probably taking a haircut.
You might be. You're paying for the liquidity. The secondary buyer needs to make a return, so they want a discount. But here is where it gets really interesting in terms of mechanics. Deferred payments.
This sounds like a car dealership tactic.
It's a financial bridge. In 2023, over 50% of continuation fund purchase agreements included deferred payment mechanisms.
Explain that.
It means the buyer, the continuation fund, doesn't pay the full price on day one. Let's say the agreed price is $100 million. They might pay $50 million at closing, $25 million in 6 months, and the last $25 million in 12 months.
Why would they do that?
To bridge the bid-ask spread. The seller wants a high price. The buyer wants a high internal rate of return, an IRR. By delaying the payments, the buyer juices their IRR because the money isn't out the door for as long. But for the LP cashing out, it means you don't get all your money instantly. You get it in tranches.
So even the cash out option isn't always instant cash.
Correct. Now, if you look at the economics of the new vehicle itself, if you decide to roll, what are you paying? The management fees are typically lower than a blind pool fund, usually around 1% instead of the standard 2%.
That seems fair. I mean, it's a mature asset, less work to find it.
Right. But the carried interest, the profit share for the GP, is often tiered or ratcheted.
Meaning the GP only gets the big payout if the asset performs really, really well.
Exactly. It aligns incentives. For example, maybe they get 10% carry if the asset does a 2x return, but if it hits a 3x return, the carry jumps to 20 or even 25%. It incentivizes the GP to swing for the fences.
There is a friction point here I want to touch on. Transaction expenses. These deals involve armies of lawyers, bankers, consultants. Who pays them?
That is highly negotiated. The lead investors often cap their legal costs. They'll say, we will pay up to $500K, anything else is on you. The big question is, does the old fund, the selling LPs or the new fund, the buying LPs, pay for the fairness opinion and the setup costs.
Because if the old fund pays, that means the people who are leaving are paying for the privilege of the GP setting up a new fund for everyone else.
Which feels unfair. But if the new fund pays, the people entering are starting in a hole. Recently, the SEC has been looking very, very closely at this. They want to make sure GPs aren't just using the old fund as a piggy bank to set up their new business lines.
I want to touch on one more mechanical piece that seems to be changing the game. Insurance. W&I insurance.
Warranty and indemnity insurance. This is the grease in the gears.
How so?
In the old days, when you sold a company, you had to leave some money in an escrow account, maybe 10% of the purchase price. This was holdback money, just in case a year later, a hidden lawsuit popped up or a tax issue from 5 years ago surfaced. That money was trapped.
Which kind of defeats the whole purpose of liquidity?
Right. So now they buy an insurance policy. The insurance wraps the liability. This allows the selling fund to distribute 100% of the proceeds immediately. It is a clean break.
And if something goes wrong, a lawsuit appears.
The liability cap for the seller is often set at $1.
$1? Seriously?
$1. If there is a massive lawsuit, the recourse is to the insurer, not the seller. It allows the GP to wire the money to the LPs and say, "We are done, no clawbacks." It has become the absolute standard for risk transfer.
Okay, so the mechanics are slick. We have options, we have ratchets, we have insurance policies. But let's go back to the elephant in the room, the conflict of interest. We touched on it, but I want to drill down. The GP is the buyer and the seller.
It is the core conflict. You cannot escape it. You have two main issues. First, incentive mismatch. Is the GP selling to generate a quick performance fee, crystallizing their carry, or are they doing it because it is truly best for the asset?
Right. If the GP is cash poor, they might force a sale just to get a check.
Exactly. Or maybe they're fundraising for a new fund and they need to show a win on the scoreboard, so they force a sale to juice their track record artificially.
Okay, and the second issue?
Second is information asymmetry. The GP knows the asset better than anyone. They know where all the bodies are buried. They know if the sales forecast for next quarter is soft. The lead investor gets a data room? Sure. But do the existing LPs really know why the GP is selling now?
It's the lemon problem. If you're selling me a used car and you're the mechanic who serviced it for 10 years, I have to wonder why you're getting rid of it.
Or conversely, why you are keeping it. Maybe you know it's about to land a massive contract next month, so you set a low price today, buy it into the new fund, and capture all that gain for yourself and the new investors, screwing the old investors.
That is nefarious. How do they mitigate this? You can't just trust them blindly.
Well, the first line of defense is the LPAC, the Limited Partner Advisory Committee. This is a group of the biggest investors in the fund. They serve as a governance checkpoint. They have to waive the conflict.
But is the LPAC always aligned with the smaller investor?
And that is the risk. LPAC members are often large LPs, massive pension funds. They might have different liquidity needs. Or they might be participating in the deal themselves as a buyer. If a big pension fund on the LPAC is rolling their stake or buying more, they might not care as much about the cash out price as the smaller endowment that needs the liquidity to pay for scholarships.
So the governance structure has some cracks in it.
It relies heavily on transparency.
Yeah.
That is why the competitive auction is so important. You want a third party setting the price, not the GP. If there is no auction, if the GP just finds one buddy to buy it, that is a massive red flag.
Now, I want to pivot to something that gets glossed over but feels like a landmine. Taxes. You call it the silent killer in our pre-show chat.
It is absolutely the silent killer in these deals.
Yeah.
If you're an LP rolling your equity, you tend to think, great, I'm just staying invested, I'm moving my chips from one pile to another. No tax event, right?
That would be the logical assumption.
And it is completely wrong.
Wait, if I don't take cash, why is there a tax event?
Because legally, you are exchanging partnership interests. You're moving from Fund A to Fund B. That effectively crystallizes your unrealized gains. The mechanism they use to track this is called 704C allocations.
Okay, hold on. 704C sounds like a droid from Star Wars. Unpack that for us without putting us to sleep.
Think of it as a tracking device for built-in gain. Let's say you bought into the original fund when the asset was worth $10. Now, 5 years later, it's worth $100. You have $90 of profit, but you haven't sold yet.
Paper gains.
Right. Now you roll that $100 into the new continuation fund. The IRS looks at that and says, hey, you walked in the door with $90 of profit already baked in. Section 704C ensures that when the new fund eventually sells the asset, that pre-contribution gain of $90 is allocated back to you first.
So I pay the tax on the old gain eventually. That sounds fair. I'm just deferring it.
Yes, but here is the trap: the cash-to-tax disparity. Suppose the new fund sells the asset a year later. You get allocated that $90 gain. You owe tax on it immediately. But what if the new fund doesn't distribute the cash? What if they reinvested the proceeds? Or what if there are holdbacks?
Tantamount income.
The worst kind. You owe the IRS a check for 23.8% of the gain, but the cash is still stuck in the company structure. You have to reach into your own pocket to pay the tax man.
That is a nightmare for cash flow.
And it gets worse for certain types of investors. Have you heard of QSBS?
Qualified small business stock, the holy grail, the 100% gain exclusion.
Right. If you hold stock in a qualified small business for 5 years, you pay zero federal tax on the gain. Zero. It is the best incentive in the tax code.
Yes.
But transfers can blow up QSBS eligibility. The rules are incredibly strict about the original issuance of the stock. If you transfer that stock into a continuation fund, you might accidentally reset the holding clock. Or if the structure changes from a corporation to a partnership, you lose the status entirely.
So you could go from a 0% tax rate to a 23.8% tax rate just because of the plumbing of the deal.
Precisely. And often the GP is focused on the big picture, not your specific tax situation. If they don't structure it perfectly, for example, by contributing a lower tier partnership interest rather than the stock itself, you lose the exemption.
And for our non-US listeners, any landmines there?
ECI, effectively connected income. If the asset is a U.S. operating partnership, transferring it can trigger mandatory withholding taxes for foreign investors. The status quo option is not always tax neutral. It is a minefield.
This is why you need good lawyers, folks. Don't just check the box on the election form.
Absolutely. The details matter more than the headline price.
Okay, let's zoom out to the investor strategy. Why are people playing this game? If I'm an LP, why should I be happy about this?
For LPs, despite the headaches, it is a tool to rebalance. If your portfolio is overweight in a specific vintage, say, you have way too much exposure to deals done in 2018. Cashing out of a CV is a tactical move. It cleans up your portfolio. It allows you to reallocate that capital to new opportunities.
And for the buyers, the secondary funds coming in, why do they want to buy someone else's old assets?
For them, it is all about J-curve mitigation.
The J-curve. That's the classic private equity visual.
Right. In a normal PE fund, you lose money for the first 3 years. You're paying fees, paying startup costs, and the companies haven't grown yet. Your returns go down before they go up. That's the J.
But with a continuation fund,
you skip the dip, you are buying a mature asset. It is already performing, it's generating cash. You step right into the upward slope of the curve. Your money starts working on day one.
And the data supports this.
It does. Single asset CVs generally outperform multi-asset pools. They have lower loss ratios and higher MOIC multiple on invested capital because you eliminate the blind pool risk. You aren't betting on what the GP might buy. You're betting on what they already own.
But there is a catch. There is always a catch. The staple.
The staple dynamic. This is aggressive.
How does it work?
Sometimes a GP will tell a lead investor, look, I have this amazing continuation fund opportunity. Asset X is a rocket ship. Everyone wants in. If you want an allocation in the CV, you also have to commit capital to my new flagship blind pool fund.
It's a tie-in sale. You want the steak, you have to buy the salad too.
Exactly. And the red flag there is pricing distortion. Is the price of the secondary asset being inflated or deflated to secure that primary fund commitment?
Maybe they give you a discount on the CV selling the asset too cheap just to get your $50 million commitment for their new fund 8.
Which hurts the selling LPs. It muddies the water on valuation. If I'm selling, I want the highest price. I don't care about the GP's new fundraise. If the GP is trading off my price to help their fundraising, that is a breach of duty.
And the regulators are watching this.
Like a hawk. The SEC is hyper-focused on 2 things right now regarding CVs. First, expense allocation, trying to stop GPs from shifting restructuring costs to LPs. And second, information parity.
Information parity.
They want to ensure existing LPs get the same data as the new bidders. You shouldn't be making a decision in the dark while the lead investor has a flashlight. If the lead investor gets a 100-page slide deck on the future growth of the company, the rolling LP should get access to that too.
This brings us to a really interesting point about performance and opportunity cost. There was some research from Upwell and Capital Group about the roll versus sell dilemma.
Yes, this is the data that keeps LPs awake at night. They analyzed thousands of transactions. They found that LPs who systematically sell in continuation funds, who just take the cash every time because they want the liquidity, incur an opportunity cost.
How much of an opportunity cost?
Roughly 8% per vintage year compared to rolling.
8%. That is a massive drag on performance.
It is huge. It suggests that, generally speaking, GPs know what they are doing. When they want to hold an asset, it's usually because that asset has legs. If you auto-sell, you are effectively selling your winners right when they are about to compound the hardest.
So the default answer shouldn't be, get me out. It should be, why should I stay?
Correct. But that requires work, that requires underwriting the specific asset, and that is the shift. The days of passive blind pool trust are over in the secondary market. You can't just bet on the manager anymore. You have to bet on the company. You have to be a stock picker, essentially.
We have covered the mechanics, the conflicts, the taxes, and the strategy. Now, I want to boil this all down. If our listener is sitting across the table from a GP pitching a continuation fund, or they are an LP staring at that election form, what is the one thing they need to ask?
The one question is this: is the general partner rolling 100% of their crystallized carried interest into the new vehicle?
Why is that the litmus test?
Because it is the ultimate test of conviction. Think about it. When the deal happens, the GP technically earns their performance fee from the old fund. That is real money. Millions of dollars. They could take it off the table, pay their mortgage, buy a yacht.
They earned it. It's theirs.
It is. But if they take that money and put it all back into the new continuation fund, if they roll it tax-free into the new vehicle, they are doubling down alongside you.
They're burning the boats.
They're burning the boats. They are saying, I believe in this asset so much, I am willing to delay my own payday for another 5 years.
And if they don't, if they're taking some chips off the table.
If they're cashing out their carry while asking you to stay invested, the alignment is broken. They are de-risking while you are re-risking.
Yeah.
Never accept that. If they are selling, you should probably sell too.
That is a powerful heuristic. So where does this leave us? Is this just a passing fad? Once the IPO market opens back up in 2026 or whenever, will continuation funds disappear?
I don't think so. I think we're looking at structural permanence. Continuation funds are not retreating. There is roughly $3 trillion in unrealized value in buyout portfolios globally. That is a massive backlog.
And the IPO market alone can't clear it.
It can't. The map just doesn't work. The machinery has changed. We are moving from a defined life asset class where you buy, hold for 5 years, and sell to a managed liquidity asset class.
What does that mean for the industry?
It means the best assets might never leave the private ecosystem. They will just move from Fund A to Fund B to Fund C. A company could be owned by private equity for 20 years.
Which means the definition of a private equity firm is changing from a trader of assets to a permanent owner of assets.
Exactly. It's becoming more like Berkshire Hathaway and less like a flip house. And for the astute investor, that offers targeted alpha. It offers J-curve mitigation, but it requires work. You have to look under the hood. You can't just trust the brand name on the door. Well, there you have it. The continuation fund. It's not just a liquidity patch. It's a structural shift in how capital moves. It turns the exit into a choice rather than a deadline.
And in this market, having a choice is the most valuable asset of all.
That's it for this deep dive. Check your portfolios, ask about the carry roll, and watch out for the phantom tax. Talk tickers.